Well, I'd like to welcome everybody to this week's town hall meeting. It's been a typical Wednesday. The market fell again today. The Federal Reserve announced what almost everybody expected with 3/4 point increase in rates. What people did not hear was the idea around how they are going to slow down in the future. It was stated that they will probably continue to raise rates. Most of us expected the 75 basis points today, but we expected it to start slowing down on the amount of the raises. And Chairman Powell did not make that seem to be very accurate. So therefore, after the announcements, the markets went up for a little bit. And then as he continued to speak, the markets went into a negative position. So our current position of that we believe that the bond or fixed income side, that the bond or the fixed income side of a portfolio still has risks. And it can also be advantageous to look at bond alternatives for that part of the portfolio. So we'll go from there. I'm going to come back a little bit later and talk about a couple other things. Again, first, let's start off. We do have an open house this Friday at the office. There is not a speaker. I will probably talk about what's going on in the markets. Mel might talk about a few things that are going on that could be advantageous with the higher interest rates around annuity rates. And I'm going to let Miss Deanna go with whatever she would want to talk about at that time so that I'm not pinning her down to anything, but it'd be from there. The other thing that I will be giving away as an enhancement for this Friday's meeting, the show Wicked is coming to this Fox Theater, and we will be giving away a door prize, dinner at the Fox Theater, plus 2 seats, and it will just be a door prize. We'll give out tickets, and whoever wins the tickets will get to go with us to the Fox Theater for a dinner. So we do look forward to seeing you all there. We are also asking if you have the availability of donating toys, new toys, to Toys for Tots. We looked at, as we do these events during the year, how can we give back? So if you have a heart for Toys for Tots and you don't make it to it, please stop it by the office. We will be doing that between now and Christmas, and we'll run it for there so that we actually give to the Toys for Tots drive. So again, I want to thank you all for being here with us today. And I want to thank those that are listening, later. The business referrals have been just fantastic in 2022. It's because people are referring people that look like them, family and friends. And we just appreciate that. So it's one of the greatest compliments that we can ever get. So I'm going to go ahead and turn over this portion of the town hall to Miss Deanna.
Okay, thanks, Steve. Yeah, we saw the Fed hike this morning, or this afternoon rather, and we're anticipating it, as Steve said. And of course, it's got the markets in a frenzy again. They're a little late to the party, right? These interest rate hikes are coming at a faster pace than what they normally. Well, I guess there is no normal. Let's go back that they've held these rates so historically low for the last decade or longer, and that has put a lot of challenges in the income planning space. We've talked about this previously. It all goes to the plan. Everything that we do goes back to your plan and your individual needs. And quite honestly, it's one of the reasons why most of our clients fire their advisor and hire us. They're looking for someone who can help them in that transition from accumulation stage to distribution stage to income planning stage. And there's so many different variables and moving parts that are going on when we're planning for income distribution. And one of the challenges that we experienced for retirees in a very low interest rate environment was, where do you find income in a low interest rate environment? And without the benefit of having a full comprehensive plan, what happens is a do-it-yourselfer often is looking for the next best thing, the next shiny penny. Where should I put my assets? Where should I invest for yield? And, you know, we couldn't use CDs. You could use bonds, but with very little yield. And then as Steve mentioned it, as the interest rates start to climb so rapidly, those bond funds particularly are taking it on the chin. And the bond funds are just being decimated across the 60-40 portfolios. We've been talking about that. If you're one of our clients, you know we've looked for alternatives in that space for a long time, but let's look for the opportunities now. Now that interest rates are starting to rise, there will be opportunities potentially in bonds or bond substitutes. We've been using, especially right now, the structured notes. So if you haven't had an opportunity to talk to us about structured notes, there's a window right now of opportunity with those, and those yields are quite attractive for income. But the window won't always be there. The thing is, these things are fluid. So again, it goes back to the plan, your plan. How much do we need to keep in cash? Yes, cash. We need some cash for our immediate spending needs. Cash is boring, doesn't earn a whole lot. You might find a high interest savings account right now, but you have to have some cash. And then you have to have something in stability, in a stable value, so that you can have access to funds without having to sell, as Mel likes to call, a depressed dollar. You don't want to have to be forced to sell something when it's down. And then lastly, how much do you need to have allocated into equities so that we can stay ahead of inflation? Because that's an important component too. But your equity portion is your longer term bucket. And you have to have all three pieces. And so the goal, the purpose of a plan, a comprehensive plan, is understanding your needs, understanding your risk profile, understanding what kind of income stream you need, and plugging together those different parts and using new, as Steve mentioned, new product opportunities. This is Mel's area. You know, he's constantly looking for those alternative pieces within the insurance space, which is why, as a planning firm, as a holistic planning firm, we are integrated. We've chosen to be an integrated practice to use both parts of those asset classes, both insurance and equities, and other fixed income alternatives, so that we can meet your income planning needs. So it always goes back to the plan. And then we have to factor in all of those other variables that change during environments like this. Interest rates are rising, and we've got an election coming up, and then we have legislative risk, and taxes are rising, and all those other things that we have to protect for our clients and their income planning needs. So that's what I had to share with you today. Focus on the plan. Always comes back to the plan. What have you got, Mel?
A headache. Just a minor little Mohs surgery, so everything's fine there. I'm going to be a little bit lighthearted with it today. I got a couple of thoughts here, because I've been reading articles. I Googled some stuff about annuities, and whenever you do that, you always get the horror story, or they're an angel sent from heaven, or somewhere in between, or they're ungodly expensive. You're stupid if you buy one, and all kinds of just hyperbole from one end of the spectrum to the other. What it really comes down to is a discussion of right tool, right job. Is someone who puts their money and keeps it in CDs stupid? Because the internet would literally tell you that was just the dumbest thing in the world you can do. Is it? We have clients that quite honestly have never done anything but CDs, or very, very very low risk liquid investments, and have done quite well with them. We have other folks that have taken a lot more risk and have been successful with it. I used to use the analogy all the time about, you know, the different tool sets and things of that nature, but let me just give you a quick example and how things have changed. The annuity of the past really doesn't hold a lot of similarities. I guess it does. I mean, the annuities have been around since the Roman Empire. They were basically an income stipend for life for centurions that survived the Roman wars and of conquest. And it was a way, and then it was used in England for centuries. That's what the gentry lived off of. They had an annuity from their investments or from their estates and things of that nature. Then it came to this country as a retirement tool. It has developed over time to be kind of a multifaceted tool. I mean, it's literally almost a Swiss Army knife these days, depending on which blade and which structure you want to use. For example, just a quick thing. If I say knife, okay, something came to your mind when I said that. Let me share a picture here. I'll show you the transition of knives over time. Which one would you rather use? I bet I could say an awful lot of nasty things about the top one, right? Okay, but it worked. It survived through, it helped people survive and help develop the human species. And it was a very valuable, workable tool. I don't think it would hold up very well to the one on the bottom. What if I wanted to do something from a distance? My goal is I don't want to get that close. Let me share another one here for you. I want you to picture a bow and arrows, okay? Now, whatever came to your mind, did it look like that? You know, yeah, Steve says yes, because he uses one all the time. Well, I have one of those, and I have one of the old-fashioned types. I don't have a picture of that here. I have a recurve bow that, you know, I am no longer man enough to pull. I can pull it, but I couldn't hold it very long enough to keep the arrow still. But the compound recurve, the compound bows today are quite sophisticated. I've had one for 25 years, and looking at it compared to what you can go out and get today, it's like, holy cow. I mean, it looks like it was built in the Stone Age. And my point to all this is this. Product changes and the tools change. Understanding risk versus reward. How much risk should you be taking? For what reward? Should you get a 3-to-1, a 2-to-1 return for the risk you're taking? What we see an awful lot is people getting, you know, 50, 60, 70% of the return they should be getting for the amount of risk they're taking. Do I need to take the risk? I mean, if I have sufficient incomes to provide for my life and I have a nice nest egg, if I can just make it grow faster than inflation, is any more than that necessary? Well, not to maintain my lifestyle, but I might have a real interest in legacy. How do I know which one is important to you without sitting down and doing a complete, comprehensive plan? Building a plan for you is really what we're all about. Putting together the appropriate tools to get the job done that meets within your philosophy and your risk tolerance. How much risk can you take, and how much reward do you expect to get for it? I mentioned this in a town hall previously, but we have one particularly new tool that I'm a bit enamored of right now. I won't go into the details, but I'll give you some of the thought process. And this is going to sound absolutely fairy tale to you, but I promise you, this is all accurate and I can prove it. It's the fixed indexed annuity that is driven by an engine that's built by a company that has designed a lot of different product that we have had a lot of history with. And I can look at the backwards and see how it has performed over the last decade, and it did absolutely phenomenal. It would have made double-digit returns. I don't expect that to go forward in the future. So when we talk about it, we're using very low numbers and expectation. And quite honestly, I expect it to do better, but I'll just use an example. Let's say 4%. The way this product works is and it's a fixed indexed annuity. So, you have a commitment for a certain period of time, and there's a limited with access to the money, and there's a 7% annual free withdrawal. So it has all the normal restrictions, and there's a fee associated with the particular index that I like to use, but it's under 1% at this point, which is probably less than most management fees. So I find that very acceptable for the potential return. And it's a leveraged index product that's optioned over time. I'll explain what that means if you decide you want to talk about it. But essentially, it returns about 3 times whatever the index does to you on average, between 2.8 and 3 and 2.8 times to 3 times. So put that in English. If it does 4, you're going to make between 10 and 12. Okay, on this particular product. Now, that's a pretty good accumulation capability with the risk of 0 as far as market returns go. Obviously, you have the surrender charges that would be risk if you decided to cash it in early. But other than that, if you stay within that 7% free withdrawal capability, and what was that rule that they use? Oh yeah, the 4% rule. That would apply quite well for something that has a 7% free withdrawal, wouldn't it? And I have no opportunity for losses due to the market, and I have a really good upside potential. But then it goes a step further. That would be if I'm interested in accumulation for myself and my spouse and income that I want to pull from the product in the future. What if my primary focus for this piece of money is I want it to take care, help pay for long-term care if I need it? And quite honestly, I might never need this money, so I want to enhance the legacy for my heirs. I want them to get a big wallop off of this piece of money as they possibly can. Okay, I've got 3 big options there. Oh yeah, it has one other feature. If they change Social Security a whole lot, everybody's afraid about getting less Social Security in the future. This has a plan built in it called the paycheck replacement, which essentially says that if your Social Security gets changed legislatively to be by more than 3%, you can trigger this product, and it will help replace your Social Security check up to a certain point for a period of about 12 years. So that's a pretty good little. Let me see now. If they mess with Social Security, it'll help cover me for that. If I go in the nursing home, it'll help cover me for up to 7 years on that. If I die and leave it to my kids, they get a 5-year payout with an enhanced value. Now, what enhanced value? Well, remember that number I gave you earlier where if it made 4, you would probably earn around 10 to 12 on this option program. Well, if you pay the higher fee, which I hadn't mentioned yet, but you can add a plus feature to this product for a cost that will double that 12% or whatever the number is. Take whatever the index really is, because I can't predict that. It might be 0, it might be 4, it might be 6, we don't know. But whatever it is, I get 2.5 to 3 times that if I keep the base program, or if I take the plus, I get that number doubled in my enhanced value. Now remember, the enhanced value can be used 4 ways. Help replace Social Security if it's changed by more than 3% on the negative, long-term care, or death for my heirs. I can still reach into my value and pull money out for my own self, but it's primarily focused on those 3 things. That looks a lot like one of those compound bows, and it's got a lot of pulleys and levers and wires on it, and it's not an uncomplicated product at all. But it is extremely versatile, and we can use it 2 ways. Excellent accumulation with little to no risk on our growth potential, or I can use the plus feature and have it enhanced for all those other things. It's a decision you can make at the time. So I hope that relationship between the changes in the tools we're using today on the financial insurance side versus the old Flintstone knife might make some sense for you. So that's for mine today.
Thank you, Mel. I'm going to go to one. There was an article in yesterday's Wall Street Journal, and it talks about the math is changing in pension lump sums. Now, I think I might have talked about this on an earlier webinar or an earlier, town hall, but I'm going to go ahead and bring it back up again, because I've had some people that have called me and said, I've got a friend that says that their company is going to reduce the amounts of their lump sum if they don't retire this year. And that's when I went to the person that gave me the call and I said, it's not the companies that are reducing the lump sum. The lump sums, excuse me, are being reduced because of the higher interest rates. Mel just talked about annuities for income, and we have to look at it. If I accept a fixed payment from my company, I'm just going to use the number $2,000. What does the company do? They either insure it themselves or they give it to an insurance company and they say, ABC needs a $2,000 a month check, and it's for both his life and her life. What's that going to cost? Well, guess what? When interest rates were in the flats to the zeros, it took a lot more money to set aside to buy that income. As interest rates have risen this year, it's going to take a lot less money to do that. So a lot of the numbers that have come out of it, if somebody was going to get a $500,000 lump sum this year, if they retire, there's a good chance that that number could be reduced by almost 30% if they wait till 2023 to retire. Then it's a lot tougher decision about, well, will I take the pension or do I take the lump sum? So that it's not the Boeings, it's not the Kentucky Fried Chickens, it's not the people that are doing it. It's the fact that interest rates are rising. So therefore, a pension has a lower current value. And that's one of the things that we get to look at as advisors for you. So the question that I've had with a lot of people that come in, Steve, if I'm thinking about retiring the first part of next year and I have a pension option, should I look at retiring now? My statement is yes. If you were going to take the pension no matter what, and you're not considering the lump sum, it's not going to change. You are not going to get more on that monthly pension or less. It's the option of the lump sum that will be changing. That is variable depending upon interest rates. So the question out there, who do you know that might be looking at retiring now or within the next 12 months that does have a pension option? And they might look at it, do I really want to weigh the options of the lump sum versus the pension? Because I will tell you that next year, the amounts on the lump sums will decline, especially with the higher increases they've had in interest rates this year. If I was going to wait 2 years and I'm taking the deal, because I had one guy, I'm going to go 2 years. Should I retire now? We ran the numbers and it's going to be fairly close if he goes with just the lump sum, because he's not going to put back as much during those 2 years. So he's sitting there in that decision mode right now. Should I go ahead and retire, take the lump sum, or just work 2 more years, stuff away as much as I possibly can and take the pension? It's a decision that we're here to help you with, because a lot of people do it very simply. They'll say, I got a $2,000 a month pension. They'll multiply that by 12 and they'll get 24,000. And they'll take the amount of their pension divided by that 24,000 and say, in 12 or 13 years, I'm going to break even. Not the best math to use when you're looking at those options, because it doesn't look at your health. It doesn't look at rates of return. It doesn't look at inflation. So again, if you have somebody that's what you know that's at one of the companies that does have a pension and you know they're close to retirement, it might be a good time for them to come in just to get a quick analysis on where they're at now versus where they could be in a year or two. Again, I would like to thank everybody that's on the call with us. I would like to thank everybody that's listening to it. Please feel free to send this to anybody that you have. or that you think it might be advantageous for them to hear some of the things that we talk about on a regular basis. Because as I look at it, I think Deanna said it best today. Planning is the most important thing. Rates of return are going to go up and down with the market. We have no control over that. But having a plan that's there no matter what happens in the markets that is advantageous for you, the client, I think is the most important thing. Remember, if you're not doing anything from about 3 o'clock, 5:30, 6 o'clock on Friday, we will be having the open house. We are accepting gifts to Toys for Tots, and we will give away a door prize. If you'd like to go see Wicked, please show up. Let's just sit and have maybe an adult beverage and some snacks on Friday afternoon. That's all I've got. Thank you all for attending.